Just Dial rallies on the back of a strong third quarter performance. Revenue grows over 16% while margins expand to a 4-year high. The management will join us shortly to discuss the numbers more in detail. Crude prices cool off overnight as geopolitical tensions somewhat ease in West Asia. Stocks of oil marketing companies as a result surge. Indus Towers trade higher as Vodafone Idea's 18,000 crore rupees FPO opens for subscription today. IIFL also upgrades the stock, citing benefits from Vodafone Idea's improved financial position. HDFC Life gains ahead of its fourth quarter numbers today. Brokerage City is bullish on the stock, upgrading it to a buy rating with a target of 720 rupees a share, just ahead of numbers. The real estate brigade continues to do well, with Brigade Enterprises surging after it's recorded its highest ever quarterly sales in the fourth quarter. Sobha also gains after the company reported a near 3% uptick in sales value for the fourth quarter. You're watching us here on Chartbusters. I'm Mangala Malu. With me is Ekta Batra joining us shortly. Looking not so bad for the market. In fact, after a day of a pause yesterday, we come back. Global markets not so well. But we did see a bit of a pop at the top, and from there we've seen some bit of recovery, some bit of sell-off, still holding mildly in the green. The good part is for the second day running, the broader markets are doing well. We have more stocks advancing for the stocks that are declining. 1,600 stocks in the green for just about 600 in the red. The Nifty holding on to its 50-day moving average. Important to see the second half of trade, largely because we have the weekly options expiry playing out. With that, what we'll do is shift focus to our special segment called Ideas for Profit, coming in from our colleagues at Money Control Pro. Lekha Badlani joins in with a stock that she's been tracking closely.
The stock that we like is Rainbow Hospitals, which is one of the largest multi-specialty pediatric hospital chains in India. In terms of its financial performance, Rainbow has the widest range of specialty offerings compared to its other mother and child care peers. Its revenue and EBITDA have grown at a CAGR of 34% and 56% between FY21 and 23. Its EBITDA margin of 27% and ROCE of 25% remain comparable with other listed players in the industry. Its cash conversion ratio has remained healthy at over 80% for the past 5 years. In terms of its expansion plans, it plans to add 880 beds by the end of FY27 to increase the capacity by 50%. It had a net cash position of around 500 crore as of December, which is quite healthy to fund most of its capex plans through internal accruals. Driven by the growth in the maternity market in India, we think there is ample room to benefit from the synergies between pediatric and gynec services. Trading at an EV/EBITDA of 22 times FY26 estimates, we believe the valuation is reasonable and any market weakness can be used to accumulate the stock for the long term. Also note that any inability to attract and retain medical professionals and weak execution in new geographies would be potential risk for the stock.
All right, with that, we also welcome Ekta on the show. Ekta, good morning. Looking not so bad for the markets, give and take everything that we've seen over the last few days.
Well, yes, and we do have a couple of cues which are lined up. We have a big set of numbers coming out today, so I think all eyes will be on that. Bajaj Auto, HDFC Life, ICICI Securities, Infosys, obviously, and Mastech. But on the economic front, globally, we do have the initial jobless claims which will be due from the US today. So that will be something that the street will watch out for. So a lot of cues lined up in terms of what the markets are probably going to react to. Like Mangala mentioned, it is definitely better for the broader markets at this point in time. But on a week-to-date basis, it's still down around 1% for the mid-cap index. But Just Dial is on our radar. The stock is surging on the back of good third quarter numbers. The company saw revenue growth of around 16.3% on a year-on-year basis. And EBITDA margins have also expanded to a 4-year high. We have Abhishek Bansal, who's the CFO of the company, joining in to discuss the numbers further. Mr. Bansal, thank you very much for joining in. Well, what stood out is definitely the margins, which have expanded to a 4-year high. What led to this, and is it sustainable? What's the guidance?
So we had a very good fourth quarter as well as full fiscal year where business was able to deliver on most metrics. I would define fiscal 24 as the year of efficiency for us, wherein we delivered growth in terms of the traffic top line in a very cost-efficient manner. So we had the exit margin of about 26.1%. And for next year, definitely we are targeting that whatever was our exit margin, we could easily or comfortably have that level for the entire fiscal year. And in the past, business has delivered even 27, 28% kind of EBITDA margins.
All right, 27, 28%. So what we were wondering is whether that sort of margin is likely sometime in the next 4 quarters. You typically guide for 20% growth at the year at the start of the year with 25% margins. That's what you did in FY23 at the start of FY24, that is. Now we're at the cusp of FY25. What are your thoughts in terms of revenue growth and margins that you're likely to do in this year?
So the target is to surely have 15% plus kind of top line growth, which would be very good in current environment as far as SME health is concerned. As far as profitability goes, the business has significant operating leverage. And as I mentioned, while we have mentioned that the endeavor is to have 25% plus margins, but last quarter itself, we were at 26% plus. So once we reach that kind of 27, 28% kind of margin levels, we will take a decision on whether to deploy part of incremental margins into advertising, which will boost my traffic and aid my monetization in subsequent quarters and years, or retain it as it is.
So 27, 28% likely in the first half of this year, given the operating leverage and 15% growth that you're guiding for?
Yes, that is possible. But as I mentioned, that as we go into future quarters, we will decide what kind of advertising spends we wish to do.
Okay. All right. Fair enough. You will decide what kind of ad spends, but that's also contingent in terms of the kind of competition that you're seeing. So if you could just give us more qualitative, maybe even quantitative information in terms of what the competitive scenario is with the likes of Google, Meta, how is that shaping up for Just Dial at this point in time?
See, for us, there is no direct competitor per se. When my salesperson meets SME, there is never a discussion that whether they would want to invest with Just Dial or any other platform. There is definitely competition in different buckets, but despite all the competition that has played out over the last decade, we have 170 million unique users on a quarterly basis. The business is doing 1,050 crores of top line as we saw. So we don't bother much about competition. Whatever is there, it is there. And the endeavor is to grow our top line and profitability.
Okay. So what do you think would probably be the biggest headwind for the company going into FY25? The biggest risk to your revenue, the biggest risk to your margin?
So the biggest risk that I would say is that while we are already at about 25, 26% plus in terms of traffic, we had about 7-8% growth. So as I mentioned earlier, that we will take a decision on how much we want to spend on advertising. So it's a call between advertising spend versus the level of margins that we wish to operate. So accordingly, we'll take a call as we go forward.
When you say take a call, what does it mean? Over and above the 3-4% that you're spending already, or you will take a call from point zero and say that, okay, this is what we'll spend. Just wanted to understand. This 27, 28%, if you're crossing the margins by, say, 1% or 2%, does that mean ad spends go to 5%, 6%? Can you explain that in detail?
Sure. So last year, we spent about 21, 22 crores on advertising. For achieving even, say, 27, 28% kind of margin levels, I can easily up my ad spend to even 30, 35 crores and still be able to achieve those kind of margin levels. But in case I see my margins possibly expanding further, I might take a conscious call to up my advertising to even overall 4 to 5% of my top line or even higher.
Okay.
And when will you get clarity on that by?
So we spend about 5 to 5.5 crores on advertising on a sustainable basis. As and when we go into future quarters, we will keep calibrating our advertising spends. So I don't think it's a matter of a specific point in time where we say that, yes, we need to spend. In a calibrated manner, we will grow our advertising spends in line with how the rest of the business is panning out.
Okay. Just to maintain this margin, which you've already achieved, any further cost cutting that the company is contemplating in FY25? I think you already reduced your sales strength. It was down around 5% on a Q-on-Q basis. Any more such reductions, any more cost cutting that we can expect from the company?
So what we did in fiscal 24 was more about cost optimization rather than absolute cost cutting. What I mean by that is, for example, in our non-sales departments, deployment of tech and automation has helped us automate several tasks which required manual resources earlier. Similarly, in Salesforce, we have tried to focus on hiring better quality talent rather than, say, focusing on quantity. So those kind of initiatives are what has helped us maintain our cost, at the same time have better output, which is what will be the endeavor for fiscal 25 as well.
Okay, so you are seeing possibly AI take over a lot of your manual operations. Is that what you indicated?
Yes, so part of our work around content enrichment, etc., is getting a boost from automation, whether it be AI or other technology tools. So that definitely is aiding us in automating some of these initiatives.
Cash on your books. That's the perennial question. What's the plan with that? At the end of this year, what does it stand at on a net basis? And what's your deployment plan here?
So 4,625 crores is the cash on our books at this point of time, which is deployed in about 7.2% pre-tax, yielding safe, efficient returns. So focus currently is on growing free cash flows. And as and when there is a conscious decision taken to either deploy or distribute this particular existing cash balance, we will obviously communicate.
4,600 crores is nearly half your market cap. Nearly half your market cap deployed in 7.2%, instruments while you focus on generating more cash. The street would have liked some more aggression when it comes to, maybe looking at inorganic opportunities, etc. as well, right?
So I think let us look at it this way. Either we could look at certain, say, inorganic opportunities, or possibly aggressively spend this money or deploy this money in aggressive advertising, etc. But what we find is that, one, we are very clear that whatever initiatives that we deploy to should have positive unit economics over medium to long term. Second, even in terms of any inorganic opportunities, just for the sake of investing, we have never taken such decisions in the past. We would rather have that cash on an efficient, safe return. But having said that, as I mentioned, that as and when there is a decision to deploy or distribute this particular treasury, we will accordingly communicate.
But at no point will you look at giving it out to shareholders, because you said even if you aggressively spend on advertisements, that's you do about 35 crores. You do a little more than that as well. Double of that will still be just 2% of your cash. So, if you're sitting on so much cash, yeah.
So as I mentioned, both deployment and distribution, both options are completely on the table. And any decision obviously will be taken to ensure it is value accretive to all shareholders.
What is the kind of acquisition that you would probably be interested in, if that is the case?
So in case we were to evaluate any acquisition, it would be any particular synergies with our core business, local search, any tools or technology which could help us add more value to SMEs, any particular products which could enhance stickiness of customers with us. So those could be some of the areas which we would explore.
All right, we take that point. Just one quick question. Your other income per year last year was just about 9 odd crores, so rather 300 crores. So you basically recognize all the yield that you make on the cash that you have on your other income in the books, right?
Yes, so our treasury primarily is deployed in debt mutual funds with about 3 years of duration. And basis mark to market, whatever are the MTM gains, we recognize them in quarterly P&L. Part of the treasury also earns tax-free interest income that also accrues every quarter.
Okay, all right. We're going to leave it on that note. Pleasure speaking with you, and congratulations again on what has been a good quarter. So that's Just Dial, stock up around 10 odd %. Need to take a short break, but once we are back, we'll be talking technical. Stay tuned. Welcome back. Well, the broader markets are definitely doing better. So up around 0.7% currently for the mid-cap index, which has picked up pace. We have a good advanced decline ratio on our hands, which is holding steady at almost, I think, around 2:1 to be fair. So 2,400 stocks advancing to around 1,071 stocks declining. So that's the gap, which is extremely wide, and let's see whether that maintains. We have Sachidanand Uttikar of Trade Bulls joining in to talk about the technicals of the market. Sachidanand, hi, welcome to the show. Well, good day for the markets. Resilient, you'd have to say. Mid-caps doing better. What's your approach?
Good morning, Ekta. Clearly, I think there is a good relief after 4 days of continuous selling. And the Nifty has tried to reconquer that mark at around 22,300. But I think if you look at the overall data set, especially the trend looks a bit bearish. Until unless we don't see the Nifty establishing a close above the 22,320 mark, the trajectory would be on the sell side. So probably every time we move towards that 22,270, 260 marks, I think we may see some selling pressure there. So I think it's a good texture on the sell on rise mode, and that's why we believe that Nifty could eventually slip towards 22,000. So at least for the day, the hurdle at 22,300 may not be breached on the lower side. We may see the expiry shaping up somewhere close to around 22,180, 22,150 itself. So I think it's a good time wherein every opportunity on the higher side should be utilized to create some shorts.
It'll be interesting to see, Sachi, because on the way up, as you mentioned, closer to 22,300, we have the 20-day moving average. And at lower levels, we have the 50-day moving average as well, with expiry in the second half. How do you play this market via stocks then?
Good morning, Mangalam. Mangalam, I think DLF and some of the real estate backed stocks are showing signs of weakness. And DLF, especially if you look at the weekly structure, it was showing a negative divergence. The effect has just started rolling out now. We saw a gap down opening during this particular week, and that particular gap is still sustained. Even here, there's a negative conversions on its 5 and 20 exponential moving averages, and that's why we believe that going forward, the stock may step towards 840 kind of a zone. We have recommended this position to our clients as well. That will be a disclosure. Keep a trading stop loss at around 882, and fresh shorts can be added on DLF. Immediately, we may see a swing towards 855, 860, but positionally, I think this particular move may extend towards 840. The second idea on the short side, wherein the trend has been very strong on the bearish side, has been Jubilant Foods. We have seen some consolidation here near the particular level of around 430, but I think eventually we may see this particular bounce back that we have seen again getting sold down to. We're expecting a price swing towards 420 levels, and that's why again this particular bounce back can be utilized to create fresh short positions. Keep a stop loss at around 456.
Okay, all right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Well, we need to take a break, but as we do that, we have an announcement to share with you all. We're launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate, Personal Finance Handbook with Sonia Shenoy, where she will be joined by 3 well-known experts. On Saturday, 11th May, 9 a.m. onwards, we'll be diving into everything you need to know to master your finances and learn how to grow your wealth, but be it insurance, tax saving, managing your portfolio, retirement planning, there's lots to learn and do, whether you're in your 20s, 30s, 40s. This live webinar is for you. We have limited seats, so don't miss this chance. Register now. Scan the QR code to register or log on to CNBC-TV18.com. We'll see you on the 11th of May.
Welcome back. You're watching us here on Chartbusters. Let's talk about a bunch of other stocks which are on our radar. Bajaj Auto set to report what is expected to be a very strong set in the fourth quarter. Sonia joins in with the details.
Well, thanks a lot for that. As you rightly pointed out, it is expected to be a strong set for Bajaj Auto. But let's not forget that the stock has had a very strong run as well. The stock is up 80% in the last 6 months itself. And the stock hit a record high of 9,356 on the 2nd of April 2024. Now, Goldman Sachs recently raised their target price to 9,380 on the stock. They spoke about how the volume growth for Bajaj Auto is picking up quite a bit. There's a pickup in the export business as well. And the three-wheeler quarter-on-quarter performance has also increased. So let's look at what the numbers could be this time around. A revenue growth of 24% is what we're staring at about 11,100 crores. The EBITDA will go up by 29%. The margins will increase by about 50 basis points year on year. And the profits will go up 30%. So no complaints with the earnings and the pace of growth that we're seeing for Bajaj Auto. The total volume growth was also very strong this quarter. Around 24% growth is what we saw. The domestic volume has been, ticking at a healthy pace of almost 30%. But the important part is the export volume growth has also recovered to about 19% year on year. Now, a lot of the export markets like Africa, the South Asian region, the demand trends have definitely improved, and hence that will lead to a margin expansion of around 50 basis points, led by lower input costs, improved mix, and an operating leverage benefit as well. But the important part is what the management commentary is. The numbers will come out post-market hours today, so we will react to them tomorrow morning. Back to you.
Okay, all right, Sonia, thanks very much for that. So that's on Bajaj Auto. We can expect the numbers today. It's a wrap on Chartbusters. Stay tuned. Trading hour up next.